Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and welcome to Casual Friday, January 11th, 2019. I woke up this morning and it was raining outside and spitting snowflakes, and after all, it is Friday, and I'm the boss here at Christensen Wealth Management. So I decided to throw on a baseball hat and a sweater and call it good and get to work. And to begin the day in this video, I'd like to do a quote from the book that I had mentioned in my prior video, Investing with the Trend by Greg Morris. In this book, he starts out with a quote from Aristotle. The Greek philosopher once wrote, "We are what we repeatedly do. Excellence, then, is not an act, but a habit." Those are some wise words from Aristotle. Well, before I go any further, please take a moment to subscribe to this YouTube channel and click the little bell next to it, next to that subscribe button when you can. That way you'll be notified whenever additional videos are posted. And in the top right-hand corner of christensenwealth.com and in the summary description of the video, you will find the social media links for Christensen Wealth. Please visit those sites when you can and like or follow them while you are there. Well, let's go ahead and take a look at the Dow, S&P, and Nasdaq and a few industry sectors, and we'll call it good and send you off on your weekend. Let's take a look. Looking at this chart of the Dow Jones Industrial Average, you can see that this is a candlestick chart. For those of you who do not understand candlestick charts, the green ones are up days, the red ones are down days, and each one of the marks on the chart represents the high, low, open, and closing prices of the day. This chart is from November 17th, 2017 until today, the middle of the trading day on January 11th, 2019. And in this Dow Jones Industrial Average chart, you can see that the Dow has come up and hit this June 28th, 2018 low right there, and that's where we came up yesterday the 10th, tagged it, and we're struggling to get beyond it again. This point right here in the middle of the screen, June 28th, is very strong resistance for this Dow Jones Industrial Average. I believe that the Dow Jones will go back down to the lows of Christmas in theory, because so many times the investment markets retest lows and retest highs. So if you look at this drop here from January of 2018 over here, we dropped 10%, bounced, came back down, tested it again, bounced again, tested it again, bounced, tested it again. So I mean, this whole point down here was tested like 4 times. We came down and made this low the day after Christmas, and then took off to the upside about 10%. And I believe that we're going to go back down and test that one more time. So my advice to investors is to use caution, because if we do go back down there again, a 10% drop is not going to feel very good. Let's take a look at a few other things on this chart. As I had mentioned in, I believe, last week's video, I think that the December drop and the post-Christmas rally could be a bearish pennant formation. And I'll draw the pennant here, and we'll start with the high of December 3rd, and then the drop down here to the low of the day after Christmas. And then we have the this is a bearish pennant formation, so it's upside down, and we'll take and draw the pennant in just like this. Oh, I need to click on that. There we go. And we'll draw that in there like that, and we'll draw that in just like that. So that is the pennant that could be, in fact, the current scenario. If this is the scenario and this does break to the downside, the textbooks say that a bearish pennant formation could have another leg to the downside equal to the length of the pennant, or the flagpole in this case. And that length of the pennant would be from here down to here, which is, let's draw that in, 16.3%. So that would mean if that does come true, we would drop all the way down to the lows of the day after Christmas and then probably drop another 3%. I believe this scenario probably will happen because when I switch to this new zoomed out chart, which goes back to the beginning of 2006 until today, January 11th, 2019, you'll see that if I draw some lines from the high of October 2007 and I connect it with the highs of 2015 right here and extend that out, and then I draw a line from the low of March 2009 and connect it with the lows of 2015 right here and these lows in here of 2016 and project that up. They converge about up here. So both of these lines are likely to be very strong support for this market. So I think there is a chance that the Dow Jones Industrial Average could drop from where it's at now and drop down 16% after breaking that bearish pennant formation and come and hit this top line, this top red line right here, and bounce off that first, and it may just bounce off and that's it. We'll see, but if it breaks it, then this bottom red line is the next line of support for the Dow Jones Industrial Average. So we'll just take it one day at a time and see what happens. In that prior chart, the Dow Jones Industrial Average has not hit its 9-year trend line from 2009 to 2018. But you can see in this chart of the S&P 500, it in fact did come down on Christmas Eve and the day after Christmas and tagged that 9-year trend line in red. So we have a low here in March of 2009, touches here September 2011, touches here in January and February 2016, and then this Christmas that just passed, we came down and tagged that line again. If this line breaks, this red line here, then because the S&P 500 does have the same type of inverted bearish pennant formation like the Dow Jones does, and if that does execute, it would mean a 16% drop from today, or from where we are today, down to wherever it goes, the length of the flagpole that is. And the next place of support for the Dow, or the S&P 500, would be these highs of 2015, and also these highs of 2016, just before Trump's presidential election. So we could, in fact, go just like something like this. It would be the path of that blue line if, in fact, that ever does come true. Like I say, it's just hypothetical. And once that 9-year trend line is broken, there's really not a lot of support for this S&P other than those two horizontal red lines there. And that could be the case for the next weeks and months in 2019. We'll just have to wait and see, take it one day at a time. Here is a chart of the Nasdaq 100 stock index, and you can see that it is still in a steep decline. If I put in the 20-day moving average, you can still see it's still pointing pretty good to the downside. And if I put in the 50-day moving average in purple, you can see it's still pointing pretty good to the downside too, but decelerating due to this most recent bounce. However, the Nasdaq bounced after Christmas and came up, and it broke the 20-day moving average, but has not been able to break that 50-day moving average. As far as resistance goes, those are resistance, especially the 50-day moving average. But if I draw a line from the high of October 1st and draw that down, capturing the high of December here, this red line is very strong resistance that the Nasdaq 100 will have a difficult time getting through. And right now it hasn't even reached it, and it may be turning down as we speak for another leg to the downside. We shall see. For those of you who are technically savvy and know what I mean when I refer to Fibonacci retracement lines, well, I would like to show you that if you draw using this line chart, which only captures the closing price every day of the Nasdaq, and you draw the Fibonacci line from the high of December, which is December 3rd, down to the low of Christmas, which is right here on Christmas Eve, you can see that we broke above the reds area, which is the 0.236 level, broke above the 0.382 retracement level, the 0.5 retracement level, and we tagged that 0.618 retracement level almost to the penny, and now we're turning down. So there is a chance that that 0.618, also known as a retracement from the high to the low of 61.8%, meaning we have bounced 61% of the way back to that high of December 3rd, hit that line and are now turning down. So we shall see if in fact it is over on this rally for the Nasdaq 100, but I thought you Fibonacci retracement people would like to see that particular chart highlighted with that illustration. If I zoom out on the Nasdaq 100 to capture the beginning of 2009 until today, and we take a look by connecting these lows, this is one original trend line that doesn't really apply much anymore because it hasn't been touched since 2011. But if I draw in a more relevant trend line that began in 2011 with this low of August 15th, 2011, we get all kinds of touches on this line just like that. We get line here in August 2011, November 2011, November 2012, December 2012, some here in April 2013, and then this one here in February of 2016. I think there's a very strong chance that the Nasdaq could come down and touch this line, something like that, just to rejoin the 7.5-year trend line that it is above anyway. We'll see if it happens. Again, it's all in theory, but it gives us something to watch for. And then also, if we take a look at this, for the Nasdaq to get down to that level, that would require a decline from today's price of 20%, which would be a very unpleasant experience for anyone who is exposed to the Nasdaq 100 and its component investments. Which, if it did get down there, that would be a complete high to low trend decline from this high of August 2018 down to that low on that red line. That would be about a 31% drop, which will never make very many investors happy. So a lot of caution needed in this Nasdaq 100 because there could be a 20% drop still coming for the Nasdaq just to get down to that 2011 to 2019 trend line. Thanks again for watching my chart update, and have a great week. See you again in about 7 days. Bye-bye.